G'day there, welcome to this video on how to use the MACD indicator to profit in the stock market. Now just before I start, I just want to make the point that any individual indicator on its own is just not enough for effective trading. So it's just part of an overall set of tools and a process that you might use. So let's get on with it and have a look at how the MACD indicator fits in with overall technical analysis. So the MACD is a trend following momentum indicator is how it's classified, and there are several of them. And what it does, it shows the relationship between two moving averages. We'll have a look at this in just a minute. But there are three components. The first one is the MACD line itself, which is the difference between two moving averages. There's then a signal line, and then there's a histogram. So three components to the MACD. Now the MACD line is the 12-day exponential moving average minus the 26-day exponential moving average. And that's the default setting that was established by the guy that developed this, called Gerald R. Pell. Now the signal line is the 9-day exponential moving average of the MACD line. So hopefully that's not too confusing, and we'll have a look at it on a chart in just a minute. But the default setting there is the 9-day. And then the histogram represents the difference between those two lines. So let's take a look at this in real time. So we'll look at BHP, and we'll go back to a really interesting period just coming out of the GFC. So look first of all at the price chart in the top part of the screen, and you'll notice that there are two moving average lines. One in purple is the 26-day moving average tracking the price, and the one in red is the 12-day exponential moving average. And you notice that from time to time those two lines cross over. So the MACD line, so if we now move to the bottom, which is the actual MACD indicator itself, you'll notice we've got a blue line, we've got a green line, and we've also got a histogram. Now the MACD line is the one in blue, and what it's tracking is the difference between these two exponential moving averages up here in the price chart. So that's just the difference between the two. So naturally you would expect when those two moving averages cross over that the MACD line would also be at zero, which is effectively what happens here. Now the green line, which is the signal line, is just basically tracking that difference on a 9-day exponential moving average. And then the histogram itself is showing where those two lines cross over. So where the two lines cross is when the histogram is at zero. So hopefully that puts a little bit more clarity around how to actually interpret the MACD. Now let's just go back and have a look at how you can use that. Now the first way is to use it when the two lines, the MACD line and the signal line, actually cross over. So that is one way to use it. And when the MACD line crosses above the signal line, then it suggests that the trend has turned up. So it's a pretty simple concept, and that represents zero on the histogram, is that point. And of course, when the trend is turning down, then you'll get the MACD line turning down through zero. Now the centerline method is the other way of using this, and it's when the MACD line actually crosses over the zero, and what that does is confirm that the trend direction has changed and could be accelerating. Doesn't necessarily mean that it is accelerating, but it means that it could be accelerating. Now the disadvantages of using these two particular approaches are that in a sideways market or a sideways movement for a particular stock, that you can get whipsawed in and out of the market, which can be extremely frustrating. We'll have a look at that on, again, we'll go back to the BHP chart. So one way to use it is when these two lines cross over. But as you can see, quite often those lines can cross over just when there's been a little bit of a short move in the opposite direction, and then when the main trend resumes, then that crossover fails and it heads back down again. Equally, you can see in this sideways period here on the right side of the chart that when the price is basically just going up and down in a sideways fashion, that you're getting crossovers all the time, and you just get tossed in and out of the market if this was the only indicator that you followed. Now, there's a way to get around that, and this is the best way to use the MACD in my opinion, and that's to use the divergence method. And what we're looking to do here is when the MACD diverges from the price action, it's a much more reliable signal to an end of a trend. So let's have a look at that situation first of all on BHP. So we can see here that the price of BHP had been falling very substantially. It had fallen from around $50 in May of 2008, and we got down to October 2008, it formed a low, had a bit of a bounce, but then went down and formed another low. So price, if we can put a trend line on this, price was still going down. But you'll notice that the MACD signal was actually forming a higher low and higher highs. So that what that's telling you is that the price was still falling, but it was falling at a decreasing rate, and so the MACD indicator had turned up. And so we then saw BHP move from $20 to $30 basically in the space of about a week. So that was a 50% gain. So that is one way to use the MACD. It's, in my opinion, a more reliable way to use the MACD for signaling entries and exits. Let's have a look at it on another stock called Harvey Norman. Let's have a look at it in the reverse direction, either as a signal to get out of a stock if you had bought it, or if you are looking to short sell a stock, then this could be a signal to do that as well. So in this case, you can see we've got the price forming a higher high, but we're not getting confirmation from the MACD. You can see the MACD losing momentum quite sharply. And even though we formed a higher price, we were losing momentum and we formed a lower peak on the MACD. So that was a very good signal, an easy one to pick to either get out or to go shorting that stock. So that's it for an explanation of the MACD. I'm going to be looking at other indicators in this series, and they will include support and resistance lines and how to use them. How to use moving averages. We'll be looking at Bollinger Bands, Fibonacci retracements, and also we'll take a look at the Relative Strength Index. And also in the series, I'm going to be looking at trading strategies. We're looking at candlestick patterns that can give you an edge on the market, and also be looking at combining price action trading with fundamentals as well. So everything that you need to know about technical analysis and trading in general is contained in these series. So if you want to keep up with what we're doing, then if you go to specialistshareeducation.com.au/blog, that will make sure that you're always up to date with all the new videos that we're releasing. So that's it for now. Cheers.